New investors get stuck over analyzing real estate all the time. They do a lot of thinking but can never make a decision, and as a result, they never end up buying properties. The community calls this analysis paralysis. I think it's a really dorky term. I kind of hate it, but it's become secular, so we're going to use it today. And the way the real estate community online handles this phenomenon is complete bullshit. They treat it like it's a series of psychological hurdles you need to cross, but once you get through this mental barrier, then you're just going to buy a bunch of properties and you're going to be fine. And that couldn't be further from the truth. The reality of this whole analysis paralysis thing is that it's systematic. There are specific things wrong with your investment strategy and your investment processes that are making it difficult for you to make decisions, easy decisions and quick decisions, and decisions that lead to good outcomes. And we're going to go over 4 real reasons why you're stuck in this analysis phase today with actual solutions to them instead of giving you some psychoanalysis. It's not a therapy session. We're going to start with a giveaway real quick. The code for today is The Cure, all lowercase, one word. It's good for 25 free copies of the legendary rental property calculator or anything else from the ACE Toolkit store that you could reach through our link in bio or investwithace.com, or this link floating over my head if you're on YouTube. Once all 25 are redeemed, you got to pay $45 for the stuff in the store. It's all really useful. If you're going to invest in real estate and you see that you could possibly use one of them, it's going to be worth more than the $45 to you. So just jump on it if you don't get the code to work. The code's not good for the course. The Virtual Investor's Guide is basically everything you need to do or learn to be able to invest out of state, 100% sight unseen without leaving your desk. That's what we do. It's based off our business model. It is pretty good stuff. You can hit the link here if you're on YouTube, or you can go to investwithace.com or our link in bio to check that out too. But that's enough plugs. Let's get right into this session. This is going to be condensed, but I'm going to give you some useful stuff that you could take back to the drawing board if you're finding yourself having a hard time pulling the trigger on properties. There's more than 4 reasons, but these are 4 really big reasons that a lot of you are going to fall into the buckets for. My format's going to be, I'm going to give you reason number 1, then a solution to it, 2, 3, 4, onwards. And the first one is, this is almost like too obvious and you're going to hurt some feelings when I say this, but you don't have enough money. A lot of people have $10,000 and they want to invest in real estate, $20,000. So what do? They're restricted to options that require them to have heavy leverage to be able to get into a property. When properties don't really cash flow with heavy leverage at the rates these days. Most properties are expensive. If there's any repair issues, you're not going to be able to afford it. So you're over-analyzing the hell out of every little condition item on the property and the rents. You don't really know the expenses that well. If you only got $20,000, you might be kind of green to the game in the first place, right? You're probably not ready to make a confident decision on a property if you're tight on cash. On the flip side of things, it's really easy to say, I'm just going to experiment with this. Take a small bite, know I have a margin of error and a margin of safety when you've got some more cash. This isn't meant to be discouraging. There's alternate strategies for you, but I remember back in the day, I think it was like 2018, we had this December where I was overly stressed out. Everything was just kind of like giving me anxiety because we had several big deals with big profit margins closing all in the same week. And I actually had to keep 2 of them for a week with my own cash to save the deal because the seller's like buy now or bust, and I had a buyer on the other end. I was going to make like 45 and 55,000 on each of these properties by the time I resold them, but I just needed to keep them for a week. And I didn't have a good amount of money in the account. I had a couple $100,000, which was barely enough to save these deals plus flip the others. And it was keeping me up at night. I was looking into each property, trying to think if it's really worth it, over negotiating, trying to solve every little problem instead of just like paying to have things fixed or paying the buyer a little credit. It freaked me out. Those same deals today, I'm not sweating at all. They're obviously good deals when you take a step back from it, but when you're in a tough financial situation, this whole game seems a lot harder and decisions are not easy to make, right? So what's your solution? Well, look, the solution is not go find some low money down technique to buy properties. That's going to put you in a more stressful situation because you're biting off even more than you can chew, right? The solution is revenue oriented. It's actually making more money. And you can make more money in real estate if you want, just taking a sales-based approach to real estate investing. You could start with wholesaling. You can be a broker. You could be a commercial broker if you want to deal with small multifamily or something else. Whatever asset class you want to be tied to, become involved with it, but on the sales and services side. And then get good at that. You'll get experience with real estate that you need. You'll probably make more money than you did if you tried to squeeze your way into a rental property anyways, and you won't be exposing yourself financially to the risks of the industry as much. Now, that's one option, but the other obvious option is your day job. And there are a lot of people that can develop their income and improve it through something completely unrelated to real estate with a higher output return for a lower amount of effort and no financial risk. You can literally go and find a way to make more money more easily than you can find a way to stretch your $20,000 into a performing rental property with no risk, right? So go and make more money one way or another, and then come back to the game when you're not overexposed financially by buying a property. You'll find it a lot easier to make a decision. Reason number 2, you don't have a criteria. A lot of people send me deals. This is an example of what I mean. Through DMs, they go, hey Elliot, what do you think about this property? And they just send me something on the MLS in a certain city. And I'm like, okay, it's a 200K duplex in this part of Ohio, probably worth about that much, looks pretty clean, rents look pretty straightforward. What do you want me to tell you? It's not under market value. This is about how much you'll cash flow if you plug it into a calculator. I don't know, is it a good deal? What do you mean, is it a good deal? You got to define what a good deal is for you. What are you actually looking for? Because if you don't know what you're looking for, you're gonna have no idea. It's gonna be like dating in high school, right? You have no idea what actually checks your boxes or not. So every property is just kind of a mystery. And you're asking the wrong questions because you don't have a target. So the solution is in a couple simple criteria to start, and you could develop this a little bit further. First, you want to determine what your investment strategy is. Am I a college rental guy? Am I a long-term rental guy? Am I an affordable housing type of investor? Am I looking for short-term rentals, mid-term, Airbnb? How involved do I want to be? Am I going to be flipping this property? What is your strategy, right? And the level of effort that you want to put into that. Then within that strategy, you start to select a market and an asset class. So you go, okay, well, I'm gonna want to do this with in a C+ or B- range neighborhood because I want something cheap enough where I could find a little bit of a lucky deal, get some cash flow still because it's affordable, but not the roughest part of town, right? So now you have a target. Then you want to set a cap rate target, income. What kind of yield do I need? Net. And then you want to say, what percentage of market value do I need to be able to buy this property for? What do I want to do there? If property is worth 200, if I could sell it for 200, I need to buy it for 180 or less to be able to say it's a good deal. And then all of a sudden, you've got a set of rules you can follow. And those rules, that criteria, will actually guide your process because you'll be looking for specific things in a specific order. So that's reason number 3 is you don't have a process at all. A lot of people don't know what they're actually going to do to determine if a property meets their criteria. And your process should have an order to it, and it should prioritize certain things that tend to disqualify more frequently and perhaps more easily with less effort from you at the top of that list, right? So if you don't have a process to find properties that can meet your target criteria, and then to analyze those properties to determine if they check those criteria's boxes, you're gonna not only waste a lot of time, you're never gonna land at a result because you're looking in the wrong places for the information that you need to retrieve, right? What is our process? Well, first I would say decide if you're gonna find deals on the market, off market. If you're going on market, you have a strategy to get to brokers, right? Or you could just go on the MLS directly. If you're off market, so you might say, hey, I'm looking on Facebook in groups, marketplace. You already know which cities you're in because you have criteria now, right? So you're not confused there anymore. And then maybe I'll even dabble in some direct mail marketing. Decide what you're gonna do there and then have your process to go and bring these leads to the table. I think the place where people really mess up is they don't actually analyze properties correctly. They analyze them in a really efficient sort of way. Here's how we analyze properties. Every day we have a deal analysis session. Our acquisitions reps bring us at least 3 prospective deals each every single day. We'll sit down, and the first thing I tell them, I say, what is it? Show me. And what is it means, give me an address, pull it up on Google Maps, look at the overhead, show me the location of the property, the part of town, the city. Now click the street view and tell me what it is. Hey, this is a duplex, 3 bedrooms per unit. Great, I wanna know what it is. Does it check out? Will I do this street? Will I do this configuration, this type of property? Then I say, great, what's the seller asking? So then we go straight to numbers, because numbers tend to be wrong way more often than condition tends to be an issue. And numbers are really quick. Condition's this long-winded conversation, right? So you dig into the numbers. What's it renting for? What are the expenses? What's the cap rate? What's the seller asking? And then I say, what's it worth? Show me the comparables, listings and sold, so we can justify creating some sort of margin of profit in it. And then once we qualify the financials of the property, then we're talking about condition. I'll go roof, mechanicals, siding, garage, basement, windows, whatever it is, exterior, structural, then mechanicals, and then cosmetics inside. And you gotta ask these questions to figure that kind of stuff out. Once you have all that and you know that checks out, you can adjust the price of the property accordingly so you can get the kind of spread you want. You go and reassess value and you say, hey, in the condition it's in, what's it worth compared to what's on the market? Find something else that kind of looks like it. And then stabilized, what will it be worth after we spend the amount of dollars that we need to on this property, right? So you're going, what is it? Financials, tenants and condition, right? Tenants if it's occupied, and value is the last bit. If you have that process, I think you'll find yourself getting to a point where you can go, all right, this is just a formula where I could say yes or no. It's just a formula you have to understand and develop, and it has more details that you bake in, but get started with a formula to get to yes or no once you have a target. And then reason number 4, this is, I don't want to make this sound like it's psychological, it kind of is. You have unrealistic expectations. A lot of investors want to go in and make a bunch of money really fast, right? But they don't expect to be an operator to do so. A lot of investors expect real estate to be passive, no matter how much someone tells them that it's not. So they'll go in, they won't talk to their property manager for 4 months, and then they'll come back to us afterwards, or they'll just look at themselves, their business partner afterwards, and go, well, this property's not working, it's not making any money, or this management company sucks, or whatever other excuse to not take the responsibility themselves for having the wrong expectations of this business and the responsibilities that they need to have to make this thing work. What I want you to understand to solve this expectation issue is you've got to ask yourself if you're in it for the short game or the long game first, right? The short game is usually more profitable in exchange for more work, more skill, and successful execution is not as easy to win at the short game, but in exchange there's a much higher reward. The long game has a higher level of predictability, a lower execution threshold, but makes you less money and is still not fully passive. Both take work. The long game takes less. It's just following up with your manager. The short game is, hey, if you want to buy, people come to us all the time. Someone came to us and said, hey, I want a 30 cap property. I went, great. That's 1/3 of market value of a 10 cap property. You know what happens when we get a property for that cheap? We sell it to you for market value and someone buys it, or we keep it for ourselves and we don't pay the taxes on the sale, right? So if you want that property, you got to go and get that mail campaign going. Hire that salesperson, figure out how cold calling works, build relationships with wholesalers, and guess what? A lot of them suck, right? So the first 5 you contact on Facebook, probably not gonna get a good deal out of those 5. We have a database of 500 or 600 wholesalers that we follow up with every single week just on a nurture, and then we talk to them about every single property they send us on top of that nurture, right? So you've gotta build a machine if you wanna win at the short game. If you have the expectations of making big money fast in real estate, that's what it takes. It's not just buying a rental property. That's the long game right there. So please expect to work appropriately for a certain outcome with your properties. That's all I have to say about expectations. There are 4 really simple reasons, folks, but you won't believe how many people don't have them. We'll recap them real quick. Number 1, you don't have enough money. The solution is go and find a way to make more money within real estate or outside of real estate that doesn't cost you much or anything. Reason number 2 that you're stuck over analyzing is you don't have criteria. You don't actually know what you're looking for. You're confused. So if a perfect deal landed right in your lap, you'd have no idea it was a perfect deal because you don't even have a profile, a criteria, right? Reason number 3 is you don't have a process to actually get to a decision. So develop something a little more clearly. We've already told you what it is. Define the property type, financials, tenants, condition, value. And then reason number 4 is your expectations are way off. You got to have a cross product of like work, skill, and outcome, return on investment. And the 3 are on opposite sides of this triangular spectrum, and you got to work your way into however your winning strategy is, right? Now, if you do all these things, you'll find that it's much easier to make decisions because of margins of safety, because of clarity on your ideal target property or ideal property profile. Because of a clear process that you have to get you to that decision. And when you get to that decision, you'll have reasonable expectations, so you'll be able to say yes or no much more easily. That's all, folks.